The broadcast is now starting. All attendees are in listen-only mode.
A warm welcome to this UKIBC webinar in partnership with Barclays, PwC and Baker McKenzie. Today we're going to be focusing on the UK economy post-COVID-19 and thoughts from our experts on what the rest of 2020 and the beginning of 2021 will look like. My name is Chris Hayes. I'm one of the directors here at UKIBC. I head up the membership team, as well as leading on the professional financial services sector, as well as the gaming sector. I'm currently sat around 30 miles north of London, enjoying the beautiful blue skies. Disney Plus is on downstairs, the door is barricaded to keep the kids out, and I've moved the Wi-Fi router right next to my laptop. So as long as I remember to mute and unmute myself at the correct times, hopefully we'll be in for a great webinar. I think we've all been there over the last couple of months. As always, I hope you and your families are all safe and well. As you may have heard from our previous webinars, this is one of a series that we've undertaken to ensure that our network are kept up to date on key matters. Our last webinar looked at the future of work, given the current crisis and the emergence and even acceleration of robotics and AI. We have also recently done an in-depth look into the Indian economy, and our previous webinars are all available to view free on our website. To keep up to date with our events, feel free to follow us on Twitter. You will see our Twitter handle and the Twitter handles of the guests are on the screen now. Ours is at UKIBC. Where you can go now, actually, we have a live poll which is relating to this event. So if you go to at UKIBC, you will see there is a question which says, how long will it take for the UK economy to recover to post-COVID levels? And there are four choices: 3 to 6 months, 6 to 12 months, 12 to 18 months, or 18 months plus. So if you go on, start voting now, we can reveal the results at the end of the webinar. UKIBC also has our own LinkedIn channel, so please feel free to follow us on that. Or on our website, ukibc.com, you can sign up to receive our newsletters. Before we start, as usual, some housekeeping. You'll automatically be placed on mute for this session. However, you will notice there is a question box which you can use at any time during the webinar to feed your questions through to me, which I can put to the panel at the end of the session. You will also be glad to know that we are recording this session, which will be placed on our website afterwards, and you will all be emailed the link in case you want to review any sections or you would like to re-listen to it or share with your colleagues or your network. So the topic today is obviously the UK economy. According to the recent OECD forecast, the UK economy will contract by 11.5% during 2020, the worst out of all the developed countries. Adding to this, unemployment is expected to grow to 9%. And recently we have seen some large-scale redundancies in the travel and tourism sector, with many more expected. There are currently 9.4 million people on furlough, and with the imminent changes to that scheme, there is a worry that there will be a lot more redundancies that will come when this finishes. Ratings agency Moody's has also warned that a no-deal Brexit would significantly damage the UK's potentially fragile recovery from the deepest recession in almost a century. On a positive note, CHADOX1nCoV-19, or the Oxford vaccine for short, is safe and has produced a good immune response in all participants. This is one of 3 vaccines in large-scale efficiency trials at the moment, with a further 30 vaccines in smaller scale trials. VAT on travel and tourism has been reduced to 5% till January 2021, and the Chancellor is even paying 50% off your food bill if you're eating out Monday to Wednesday in August. But before you rush out to all book your Michelin star restaurants, it's up to a maximum of £10 only per person. To support us through these difficult challenges, we have some experts on our panel: Henk, Sunil and Samantha. To help us look at the macroeconomic challenges as well as some of the fiscal measures the UK government has put in place, I'm delighted to welcome our first panellist, Henk. Henk joined Barclays Bank 20 years ago as a graduate and worked as a stock market analyst focusing on UK equities before rising to the position of global equity strategist in 2001. In 2018, he was appointed Market Strategist Director for EMEA, where he works as part of a team formulating and communicating investment strategy to internal and external clients. In his role, Henk analyzes a wide variety of asset classes, including equities, currencies, and commodities, as well as looking at the effects of macroeconomic changes to the financial markets. Henk, it's an absolute pleasure to have you on board and really looking forward to your presentation. Over to you.
Well, good morning, everyone. It's a pleasure to be with you. There's going to be around about 7 minutes or so to give you some opening remarks around the outlook for the global economy. So I thought I'd focus on two major areas. Firstly, the impact of the coronavirus on the global economy, the policy response, the broad policy response that we've been seeing, and then spend a little bit more time with an in-depth view of the UK economy, focused on what the numbers that we have been seeing, what we can expect in terms of the Bank of England, and analysing the fiscal response. And as I say, I'm sure there'll be plenty of time for questions after that. What we do know is, from a broad perspective, COVID-19 lockdown has thrown the global economy into recession. The pandemic has resulted in millions of infections, as we know, and hundreds of thousands of deaths around the world. The scale of the outbreak has placed enormous pressure on national health services. Governments have been forced to impose aggressive measures, including social distancing, self-isolation, and restriction on travel, all in efforts to try and contain the spread of the disease. The locking down of economies has resulted in an unprecedented drop in economic activity, surging unemployment, permanent losses in output, and temporarily slower potential growth. As a result of the disruption that we've been seeing, we now expect the global economy to contract somewhere by around about 3.6% during the course of this year. Provide some sort of context around that and talk about the significant change in outlook. At the start of the year, for example, we were predicting growth for the global economy of somewhere close to 3.3%. In terms of the policy response and the economic outlook, well, the scale of the risk to the global economy, as we know, has encouraged central banks to slash interest rates, to inject huge amounts of liquidity into the financial system. Governments have embarked upon an extraordinary fiscal response, including allowing companies to furlough staff, as well as pledging vast sums in loans, grants, and credit guarantees. But the reality is, future growth prospects will inevitably be determined by the lifespan, the intensity, and the geographical spread of the virus. However, a controlled lifting of restrictions should help to alleviate some of the economic pressure. Although, of course, we need to be realistic, activity will continue to be vulnerable to the development of a second wave. And a true normalization of activity will only occur when a vaccine has been developed. Given the time required to develop, test, and distribute a vaccine, it's unlikely to be widely available until the first half and probably the end of the first half of 2021 at the earliest. But I think with tentative reopening of economies, the vast level of stimulus instigated by policymakers, we are projecting a recovery as we look through the second half of the year and into 2021. We're forecasting global growth to be around 5.2% as you look through next year. However, certain sectors, and that's pretty obvious, but certain sectors, airlines, hospitality, retail, may take many years to recover. And we also think there's likely to be some permanent changes to working patterns, supply chains, and global trade. Looking at the UK economy, the pandemic, of course, has disrupted the UK economy, the country facing the highest number of deaths in Europe, although you can debate about exactly how these numbers are calculated and differences between different regions. But sticking with that headline, clearly it's had a dramatic effect in terms of the UK economy. The recent data suggests the recovery is probably less robust than some analysts have been anticipating. Figures show the UK economy grew at a slower than expected pace in May, even as the government eased some of the coronavirus lockdown restrictions. Gross domestic product rose 1.8% from April, when it plunged, of course, by a record 20%. That was significantly lower than the 5.5% forecast for the month, left output down by 19% in the latest 3 months. There were gains, particularly in manufacturing and construction, as workers were allowed to return to work, with a dominant service sector industry expanded by just 0.9%. Some other sector remains subject to the lockdown. But I do think there are some reasons to be optimistic. April is expected to be the low point. Activity is rebounding as the economy reopens. If you look at a range of more higher frequency factors. If you look at mobility indicators, for example, they show a pickup in public transport indicators and driving activity. Electrical power load usage has rapidly recovered from the April low. And there's even signs that households are indeed willing to normalize their spending patterns reasonably quickly. Footfall levels in stores have been rising, sales volumes have been rebounding, or they're still left down on where they were compared to last year. In terms of the numbers for the second quarter, we're forecasting a contraction of 17%. You can argue exactly what that means, but in some analysis could suggest that's the worst that we've seen in 3 centuries, although we should remember that's somewhat better than was feared only a couple of months ago. For 2020, we think we'll see a contraction of 7.5% this year. For 2021, we think the recovery will be supported by the significant fiscal stimulus and monetary easing that's taking place. We're forecasting growth of 5.8%. Very quickly, looking at UK inflation, fell, as we know, to a 4-year low in May. Consumer prices rising just 0.5% from a year earlier. Mid-week demand. Fuel prices, of course, have been falling. There's also weakness in transport, recreation, and cultured goods. And only a modest upward pressure coming through from food and non-alcoholic beverage prices. In terms of the outlook for inflation, CPI inflation is expected to fall slightly further in the near term as a drag from COVID-related shocks build. But then it's expected to rise during the course of 2021. The direct impact of the recent fall in the oil price drops out of the annual comparison. The downward pressure from domestic factors wanes as demand starts to recover. In terms of the Bank of England, what can we expect there? Well, the Bank of England, as we know, have already cut rates to a record low of 0.1%. They've increased the size of that bond buying program by a further £100 billion, taking that total to an astonishing £745 billion. But they did say they would slow the pace of purchases quite sharply as that higher frequency data points to a faster recovery and the stabilisation that was seen in financial markets. Certainly better than the Bank of England was previously predicting. They said the plan to stretch out the programme until the end of the year, but to be fair, by any timetable, by any historic standard, it still looks pretty aggressive. What are they hoping to achieve with those purchases? Well, they're looking to boost economic activity and reflate the economy. Large-scale purchases of government bonds lower the interest rates or yields on those bonds, thus pushing down the interest rate offered on loans, particularly like the mortgages and business loans. Cheaper borrowing should encourage spending. Quantitative easing should also, remember, boost asset prices, that in turn drives the wealth effect and should lead to an increase in spending. But we should also acknowledge there could be some unintended consequences from quantitative easing, putting pressure on investment strategies that rely on long-term interest rates for a return, particularly like the pension funds, which encourages investors to take on more and more risk to get a return. Inflating asset prices also generates further income inequality. Lots of debate around negative interest rates in the UK. The governor recently said taking borrowing costs below zero was complex and not in any way imminent. Negative interest rates, to remind you, is where central bank charges retail banks on its deposit excess reserves with the central bank instead of normally paying an interest rate. The theory being that it makes it expensive for the banks to sit on reserves, forcing them to lend the money, thereby stimulating growth and reflating the economy. Does it work? Well, even the threat of negative interest rates, of course, pushes down borrowing costs. Britain recently sold a bond with a yield below zero for the first time. But again, there are some unintended consequences. Of course, havoc in the banking system leads to declines in net interest margins. Europe, of course, is a good example of that. Discourages companies from holding adequate buffers against financial stress, and also encourages investors, as was saying about, take on more and more risk and can create asset bubbles. For us, I think we would need to see a massive deterioration in growth expectations for the Bank of England to consider such a move. I think policymakers are more likely to remain focused on a coordinated monetary and fiscal approach, measures that enhance liquidity, address dysfunctional markets, boost confidence, and of course, stimulate demand. Let me quickly think about the fiscal position. You know, the government has injected hundreds of billions of pounds trying to stimulate the UK economy, primarily aimed at tackling the fallout from the outbreak. The funds have been channeled through accelerated infrastructure projects through the recovery phase, loan guarantees to businesses, and the furloughing of staff that we've been talking about. Those 9.4 million workers have been furloughed. Remember, cost the government something like £30 billion. The Chancellor, in his summer statement, continues to spend. He confirmed the furlough scheme will end in October. There's new support measures, including a job retention bonus for retaining furloughed workers, a VAT cut that we've been hearing about, temporarily raise the stamp duty threshold. The government is also putting in place funding to cover the national minimum wage for 6 months for new jobs for 16 to 24-year-olds. This is a group that's been particularly affected. There's also provisions to boost skills and apprenticeships. The Chancellor has also made the transition to the green agenda an integral part of the recovery, with funding to make public buildings and housing more environmentally friendly. These expansive actions, of course, come at a cost. UK government has gone through an unmatched rise in peacetime borrowing. We predict UK debt to GDP will surge from 83% last year to somewhere closer to 101% by the time that we get through 2020. That's really how we see the UK economy, the state of the nation's finances. I know the clock is against us, the time is up. So let me hand back to the moderator, but I know there'll be plenty of time for questions. Perhaps we'll have a look at Brexit, which has been a little bit overshone by COVID-19, but still likely to have a profound impact on the UK's growth prospects. Back to you.
Cheers, thanks, Henk. Thanks very much for that a very interesting overview, and interesting your point about 7.5% drop this year and a 5.8% growth. That's sort of in line with our poll at the moment. 2/3 of the respondents are suggesting that the recovery will take more than 12 months. So don't forget at UKIBC to have your vote on that. And also, coming to your point of picking up on public transport, next we have Sunil Patel, who is from PwC and who is actually speaking to us from their London office. He travelled into London today on transport, so one of those people who are part of those transportation figures. Sunil is the Chief Operating Officer and Head of Capabilities for Technology and Investments at PwC. He is also the Chair of the UK-India Business Group. Sunil has over 28 years of experience working across a range of industries in the UK and on an international basis. He combines his strategy, management and technology consulting expertise to help clients transform their businesses. He has also led a number of high-profile and complex assignments within the healthcare and government sectors. Sunil also sponsors the PwC Hindu Network and is one of the excellent members of the UKIBC board. Sunil, really looking forward to your presentation and to that deeper dive into some of those key sectors that Henk has alluded to.
Thank you, Chris, and good morning, everyone. Hopefully you can all hear me. So yes, as Chris mentioned, I'm actually doing this webinar from our London offices of PwC on top of Charing Cross, so I'm one of the people that's come back to work today. It's actually, I was saying to Chris at the top of the call, been a very pleasant journey in and out of London when I've come in the last couple of weeks, generally just doing a day a week in the office at the moment. So I've been asked to just talk to you about the impact of COVID-19 really on the UK economic sectors and dive into a bit more detail. Henk's given you the macroeconomic perspective, but what I thought I'd do is give you that perspective on the economic impact by sector. We're going to also do, I'll give you some trends that we're starting to see as people emerge from lockdowns. These are sort of pan sector, and then we're going to do a deep dive on 3 particular sectors, just to sort of explain to you what we're learning, what we're seeing, and I suppose what the prospects are for those sectors. So first off, you see on the slide there, we tend to agree with what Henk has put out there. We see a big contraction in the second quarter, 16-17% contraction in UK GDP. You look at this chart, you know, and it's a sea of red across all of these sectors. You can obviously see the biggest impact is around hotels and restaurants, but you can see sort of other sectors all being impacted. Arts, culture, hugely impacted as we're in the summer going forwards. Education, heavily impacted since the lockdown in March, with schools, universities all struggling to continue. And then other sectors, you can see the impacts there in terms of percentage contractions between April and February. We see mixed fortunes in retail. Clearly retail, parts of retail, non-essential retail clearly shut down, but obviously essential retail did continue, and there's been obviously a partial offset there. And we do expect across all of this, all of these sectors, things to improve. I think the one thing we'd say is that things will improve in different ways across these sectors. So I'll give you a bit of commentary on that, and we'll go into 3 of these sectors. So if we move on to the next page, one thing you'll find on our website is, and you see the URL at the bottom there, we've actually produced 24 sector reports, and you can see sort of icons of those on this page, which actually looks at what we're learning from each of these sectors, as well as where do we think they're all going to go. And I think we see beyond survival, and obviously that's the #1 priority for most businesses right now. Can they survive? Have they got enough cash flow? Can they see out this period? But beyond survival, we see 3 common themes. So regardless of which sector you're in, we see the same 3 things coming up. And #1, the first priority, I think, for most CEOs and CFOs is around securing the workplace and workforce. So can they bring their workers back to work? Can they be productive? Can they work from home? Can they actually resume operations, I suppose, just normal day-to-day operations of the business? And can they do that safely and securely? That's the #1 priority for most executives right now. The second priority, and we're seeing this really starting to increase, it was there pre-COVID, but I think the appetite for this has definitely increased, which is the use of automation and technologies. So many more executives and boards are looking at driving technology into their business models. So previously, if they were skeptical about technology, they've been converted, and really we see technology being used in every single business and every single sector going forwards. And the final thing that we're seeing is really an acceleration of transformation. And I'll touch on this in a second, but we're really seeing all businesses look to accelerate their own transformations, because some of what's happened through COVID and the lockdown is going to stick. There is no going back to what we had pre-lockdown. So most businesses and organizations are really thinking through, what does the future business model look like and what will sustain through this period? Because I think, as Chris has mentioned and Henk has mentioned, this is not a short-term period that these businesses will have to survive and thrive throughout. This could be a prolonged period. So let's go to the first sector. So let's do a deep dive. So the first one up is travel and leisure. So this has been, I think, unprecedented impact for the travel and leisure sort of industry over the last few months. Everything literally shut down. My wife works for British Airways, and I'm sure you've all read about what they're doing. But basically, all flights grounded, potentially 12,000 job losses at British Airways, and airports only just recently starting to resume activity, but obviously on a much lower volume and demand basis. You will see that we think this sector has a lot of jobs at risk, and this is one of the sectors in which people tend to not necessarily be able to work from home. Travel and leisure is an experience-led sector. You have to go places, see things, want to do things. It's not something you can just consume digitally, let's say. So that's some of the constraints on the sector. What we're learning clearly is that, as Henk has mentioned, with the overall growth figures for the UK, we expect households to tighten their belt. We expect a third of households to have less disposable income over the next 12 months, and they're going to be much more judicious about how they spend that money going forwards. And in terms of where we think the sector will go in terms of returning, we do actually feel this sector, travel and leisure, is one that we're optimistic about. Now, in the short term, it's not going to return to normal. Clearly levels of tourism is down, levels of interest in business travel is down ultimately right now. But we do think, being an experience-led sector, and for any of us who've traveled, you can't replace being in Rome or being in a restaurant in a foreign location. You can't replace some of these things. So we do think this sector will return. It's going to be a long-term challenge, I think. So it's probably a multi-year, probably 2+ years before this sector returns to the levels that we saw pre-COVID. And what I would say is quite a number of the changes that we've seen in the last few months are going to stick. Give you an example. I used to go to the gym, every weekend to do certain Pilates classes. I now do those online. I don't think I would go back to the gym to do my Pilates class. I'm just going to continue to do that virtually. So we're going to see lots of different things from a leisure perspective that are going to be digitized or provided online. But I think aspects of travel are going to return, but probably in the long term. So that's travel and leisure. Let's look at transport. Different sort of sector. We've learned a lot about transport. So see, transport, I think, has also gone through huge impacts in the last few months. But I think we've also learned how not traveling has impacted and benefited the environment. I think we've all seen it. Whether you're in your gardens, you can hear the birds are singing, you can see more nature, and you can definitely see lower emissions, certainly across London as a result of the last few months. So this is one of the sectors that I think we've really understood that without effective transport, we cannot kickstart the economy. I had to use an overland train and an underground train to get to work today. Without those two services running today, there's no way I could have got to work today. So I think it's brought into sharp focus the role that transport plays in, I suppose, enabling and facilitating our economy. But I think we've also seen huge benefits and people being much more selective about when they travel and how they travel. Now, we've seen opportunities, particularly in the cities, I think, for a lot of smart, innovative technologies to start being used. We've seen a big increase in people cycling and using e-bikes. Clearly a move towards more fuel-efficient vehicles, and I suspect an increase in electric vehicles as well going forward. So we do see benefits in the transport sector going forwards, but at the moment, the mass volume that we had on the transport system has gone away, and people are making individual choices about where they will travel, how they will travel, etc. So one of the things we see for transport is that transport will need to become a lot more data-driven, a lot more digitized in terms of ticketing, and providing, I suppose, consumer choice and convenience to their users. Previously, it was a mass system, and you either had to get it and work the system to get from A to B. But whereas I think we're now going to see a much more consumer-led transport system that's going to come through. And I think the benefits for transport ultimately are going to be, we could see many more positive impacts on the economy and the environment and society. So if travel and leisure was sort of long-term impacted, but will sort of come back to normal probably in 2 years, I think transport is one that's going to go through a fundamental rethink, because I think we're going to clearly see many less people, much less people coming into city centres, working in offices, etc. So transport is going to go through a revolution, I think, over the coming years as well. And there's opportunities in that for the people who are willing to take a different approach to providing services. And then the final sector for a deep dive is retail. Now, retail, it's been an enormous challenge, I think, for retail businesses. Now, we've got obviously essential retail, the supermarkets and the places that people are still going to get their food supplies and medicines and pharmacies and so forth, that are continuing and have, I think, actually done well over the last few months. But for non-essential retail, and that's what I'll focus on here, clearly a massive impact with the national lockdown, and currently we have some localized lockdowns around parts of the UK at the moment. So I think retail is probably the most challenged sector at the moment in terms of trying to work through what they will do to come out of this lockdown. Lots of people you can see are moving towards online channels if they didn't have those online channels, and we see more consumers willing to buy products online, and that will continue, I believe, going forwards. But I think really we see a real rise of the consumer now in the retail space. So we really see retailers having to really think through what their business models are going to be like. Can they afford to keep retail premises in city centres open? Will they have enough footfall in these locations? Or do they move away from those costs and move towards more maybe digital cost, or maybe online cost, where they can sort of continue to serve and tap into new markets? So I think the picture for retail, we think clearly retail is starting to emerge, shops are open, and people can resume, but we definitely think here consumer behaviour and sentiment will have changed, and that the retailers that really work their way through, I suppose, reshaping their businesses at this moment in time will be the ones that come through this period in the next year or so in terms of good growth going forwards. So that's really what I'm going to say around the sectors. There's much more that you can see on the website that I put up for each of the 24 sectors that we've got. But what I would say is we're starting to see sectors return. They're all returning in slightly different ways. They've all got different pressures and challenges. And what we are starting to see is real opportunities for the organisations that are brave, that are willing to change things, to take opportunity and to differentiate themselves as we come forwards in Q3 and Q4 of this year. Back to you, Chris.
Yes, thanks, Sunil, and thanks very much for that overview. Great to see those 24 sector reports which people can look at, and obviously that deep dive that you did in the travel and tourism sector. I'm one of those people who absolutely love to travel or holiday for the summer, which was meant to be to the US, has been cancelled, of course, but we've just recently booked to go to Greece instead. So let's see, hopefully everything will work out well. And also interesting to hear about those companies that are advancing in terms of technology. I know there was recently a program showing how in Japan they now have robotic receptionists, and interestingly how people might change their views in terms of wanting that human interaction to wanting a more automated experience given the current situation with COVID. Just a reminder, if you have any questions that you would like me to put to the panel, please do feel free to fill in the questions section. I can put them to the panel at the end. And our UKIBC Twitter poll is still running. The vast majority of people are still saying that the recovery will take more than 18 months. So please feel free to cast your vote on there. Finally, I'm delighted to welcome Samantha Mobley to give her views on what is the outlook for merger and acquisitions and FDI in the UK, especially given the current geopolitical issues that we've all been hearing about. Samantha is a partner in the EU Competition and Trade Practice of Baker McKenzie. She is an active member of their India Steering Committee and coordinates work carried out for Indian clients, as well as being a member of the Management Committee of the firm's London office. Samantha has significant experience in advising on multi-complex jurisdiction mergers, and also has a strong understanding of the importance of working strategically and effectively with global regulators to find a pathway to close a deal. Sam has been identified as one of the top 150 women in antitrust by Global Competition Review last year, and has been appointed a non-government advisor by the UK Competition and Markets Authority at the ICN, the International Competition Network. Sam, really looking forward to your presentation. Over to you.
Thanks very much, Chris, and good morning to everybody. I'm delighted to be here. So what I thought I would do is examine the following questions. What exactly has happened to M&A, sort of both globally, but also in the UK? What's going to happen going forward to the best that we can anticipate? Does merger control still matter? Is my area of the law at all relevant anymore? And also, what about foreign direct investment? Is this in fact still welcome in the UK, given some of the legislative changes that are taking place, and indeed even one that took place this morning? So perhaps let's start off by talking about what's happened to M&A. I think this slide will come as no surprise. I was actually looking back at our global transactions forecast that we do with Oxford Economics each October. So I look back to the one we published in October 19, and you know, the forecast suggested that 2020 would follow a similar pattern to 2019. Obviously, there was geopolitical uncertainty putting a dampener on deal making globally, but there would be bursts of activity across many sectors, and many companies looking to gain a technological advantage and enhance their digital capabilities through their deal making. And then back in October, we said, well, for the UK, obviously there was lingering uncertainty around Brexit, dampening enthusiasm for deal making. But, you know, if we saw an orderly departure from the UK, from the EU, then a recovery of investor confidence. And we actually at that moment predicted a 2 to 3% increase in deal value in the UK for 2020. Of course, then COVID happened. All that was before COVID. So what actually happened, as you can see, is that M&A fell off a cliff, both globally and in the UK, as the pandemic prompted deal makers to shelve transactions. These statistics that you see here are for cross-border deals completed in Q2 of 2020 compared to Q2 of 2019. And the number of deals in volume terms really halved, both globally and in the UK. And in terms of deal value, the deals in aggregate globally are worth 25% less than what they were previously, and 15% less, and less than 15% of what they were this time last year in the UK. So it's not been so good, I would say, for deal making so far. But what is the future? I think that there was absolutely this collapse in deal making in the first half of this year, but we've actually started to see a bit of a pickup in activity. And we think that that's because there's been a backlog of deals that are now getting done. And also, we think that there's now a window of opportunity, because as the previous speakers have said, you know, we may find ourselves with a second spike. And so I think what we're seeing is that clients are regarding this as a little bit of a window of opportunity. And then from November and December, when we move into winter and perhaps we see a second spike, we'll see a flat line or dip in terms of when things become more challenging, and of course as Brexit kicks in. But consistent with previous speakers around the outlook for the economy in general, I think we're hopeful that, you know, as we move into the second half of 2021, deal making will start to come back, both globally and in the UK. So if we look at the next slide, which you've now put up, thank you very much. Interestingly, as we see it, tech deals have been the most resilient. So the prediction we did make last year about companies seeking to enhance their digital capabilities despite the geopolitical turmoil, that remains the case with COVID-19. And I was interested to hear Sunil talk about one of the things that they're seeing, which is the use of automation and technology and driving technology into business models in every business and every sector. And I think that that is consistent with what we're seeing in terms of deal making, because if you haven't got it and you're not going to get it through a supply contract, then you buy the technology in order to integrate into your business. So I think that's exactly right. Obviously, some of the other sectors that have been mentioned, you know, tourism, for example, that remains pretty depressed when it comes to deal making. And I think the reason we haven't seen distressed deal making so far is because of the point that Henk made, which is there's a lot of government support around at the moment. But I think we may start to see distressed deal making as and when the taps of the government money is turned off. What we are seeing are deals being done in a different way. So site visits have to be virtual, have had to be virtual up until now. So, for example, the use of drones in site visits has been happening. We see due diligence questionnaires and also replicated in warranties, a really different focus on what buyers are looking for. So, you know, counterparty risk, commercial contracts with force majeure, a concentration of risk by reliance on a major customer. Does that exist at the moment? Target risk is a focus. So scrutiny of financial performance and forecast, participation in the government schemes. Is there participation in the government schemes? Supply chain robustness. What operations are mothballed? So different questions being asked. Also around the workforce. You know, sickness statistics, what's the possibility to work remotely? You know, is exactly as Sunil said, the business model has completely transformed, and the questions that buyers are asking have similarly changed. IT systems risk questions are very prevalent now, so questions around cybersecurity attacks we're seeing a lot of. The last point on this slide is the one about private equity. Private equity has a lot of money to invest, and the record level of their capital needs to be deployed. So a lot of the deals that we're working on at the moment are private equity deals, and I would expect that trend to continue. So if we move to the next slide, the next question, you know, does merger control really matter? Should we be saying to the antitrust authorities, so for the UK economy here, we're talking about the European Commission, if the deals are of a particular size, or the Competition and Markets Authority here in the UK, otherwise? You know, should we be saying to these regulators, you know, these different sectors that we've been talking about, they've been decimated. We should be allowing businesses, even if they compete with each other, we should be allowing them to merge. Well, it's not going to be quite straightforward as that. So first of all, from a process perspective, it has been difficult for both the Competition and Markets Authority and the European Commission to continue business as normal. So they've had to change their practices. They've had to extend their review periods in light of COVID. But on the whole, they're coping pretty well with the need to work remotely. On the substance, the view is very much, or the message coming out the regulators is very much, it's business as normal. This is reasonably short term. Our job is to look at lasting structural impacts, and if we don't like what we see from a merger control perspective, we're going to prohibit the deal. And an example of that in the UK was JD Sports and Foot Asylum, where in the fashion sports shoe area, the regulator, the CMA, said, well, actually, you know, we see there's been a complete collapse in demand, but despite that, you know, we're looking at this for the long term, and we think this deal is anti-competitive. Needless to say, the acquirer does not agree with this view and has appealed this outcome. The other point that's been quite hot is the failing firm point. You know, there's a mantra in merger control, which is that, you know, if a firm is failing, you ought to allow the acquisition of that firm, even though the two competitors may look strong together on paper, because the firm would have failed anyway. Interestingly, the reason I've got the Amazon and Deliveroo logos up there is that was an argument and a point that actually gained traction in the Amazon minority investment in Deliveroo. So in April, the Competition and Markets Authority came out and said provisionally, yeah, we see that. We see that the Deliveroo is absolutely desperately in need of significant additional funding. Only Amazon can provide that, and so therefore, you know, we're willing to allow this transaction to go through. Just last month, though, in its final findings, the CMA changed its mind and said, well, no, actually, you know, the delivery market has bounced back, as we all know, because we're ordering our meals to eat in our homes, and it's no longer the case that Deliveroo is likely to exit. However, given that Amazon's only taken a 16% shareholding, we still think there's not going to be a problem with this deal. So interesting times around the failing firm defence. You know, the European Commission as well has also said that we're not changing our rules on this. Yes, there is a failing firm defence, but there are criteria that need to be complied with, and that defence shouldn't be a shield to allow mergers that would otherwise hurt consumers and hold back recovery to go ahead. One final word on merger control. Everything changes at the end of the year as Brexit kicks in. So what's going to happen going forward is that your transactions and your acquisitions in the UK are going to be scrutinised by the UK Competition and Markets Authority in the event that they have an impact on the UK, and the EC loses, European Commission loses jurisdiction over those particular cases. Next slide. My final point is about foreign direct investment. What we've seen globally is that countries around the world have started using upping the ante when it comes to foreign direct investment and national security screening of that investment. We see this everywhere, including in India. In fact, the FDI system in India, the screening system has recently been enhanced, and we also see that here in the UK. So very briefly, the national security issue used to be around acquisitions by foreign investors in defence and critical communications, but as you can see from this slide, increasingly and in light of COVID, the sort of targets in which investments are being made has proliferated. And so even just in the last month, the UK government now wants to scrutinise investments in public health targets in order to safeguard the ability to tackle the pandemic. And I don't think that's temporary. I think that's going to stay, as well as the introduction, just on the last bit of this slide, of a new act, the National Security and Investment Act, which is going to create a whole new CFIUS-type regime in the UK. What does that mean for investment, and particularly investors from India? I think it means more red tape and possible structural requirements when it comes to investing in the UK. But largely speaking, for Indian investors, this isn't a blocking issue, and I would leave you with the thought that, you know, in only earlier this month, OneWeb announced that the UK government and Bharti Global Limited had acquired OneWeb in order in the satellite business in order to take that business forward. So the message is the UK is still open for investment from India, but there will be some scrutiny. Chris, I think I'll hand back to you, given the time.
Cheers. Thanks very much for that, Sam. Really interesting points there about obviously the private equity, and given those extremely low interest rates, obviously looking for the right kind of investments. We're opening up now the questions section, so please feel free to send the questions. I've got a few of them already coming in. And just a reminder, our @UKIBC Twitter poll is currently showing that, quick calculation in my head, 77% of the people who are voting are suggesting that the recovery will take more than 12 months. The largest proportion saying it will take even longer, 18 months. So just going to the questions then. First question as the chair from me. Henk, just a question to you. I think a lot of countries are obviously really worried now about a second wave hitting in the winter. There seems to be a lot more talk about that. The UK government has obviously suggested they would not do a national lockdown again. What's your thoughts on the sort of the impact second waves would have, and have you actually sort of built those into your forecast of sort of 7.5% decline in the growth in the next year?
Well, I think what we've been seeing is obviously we had the first wave, we had the lockdown effects being put in place, and that, of course, were significant and had a significant impact in terms of economic activity that's been taking place. What we should remember is that not only governments but also medical practitioners have learned an awful lot during the course of this process already, and the hope is, of course, we've learned in quick or short order how to deal with some of these problems. So perhaps we should bear that in mind. As I said at the start, the reality is the economic outlook will be determined by the lifespan, the intensity, and the geographical spread of the disease, and that continues to be true. And when you look at United States, where of course you've seen reintroduction of restrictions in the likes of California, in Texas, and in Florida, it shows you how quickly the economy can be thrown back into reverse once again. So I think we will be watching the pandemic very carefully. The path of the pandemic is very important, but we'll also be watching the scientific efforts as well and seeing how those two are likely to converge. But the major point, I think, really is past the worst. Even if we don't go through a formal second wave, it's hard really to establish what that means. But if past the worst doesn't necessarily mean out of the woods nor back to normal. For us, we think COVID-19 crisis have many implications for society, economy, and financial markets over the course of the long term. They include more debt, fiscal deficits, public debt have been skyrocketing, as we've been talking about, as has corporate leverage, higher levels of inflation. I think less globalization will be important as well. COVID-19, we think, accelerates deglobalization, which started with the trade war, prompted governments to promote self-sufficiency. We've been hearing about some strategic areas, and that's likely to continue: food, healthcare, and defense. Technology, I think, is going to be a big theme of what the post-COVID world looks like, and particularly if it becomes more vulnerable to a second wave. Technology has played a key part in keeping the economy afloat when the world went into lockdown. More people working from home, virtual meetings like this, less business travel, less office space needed. We think it accelerates the digitalization of the economy. I think more healthcare as well, something we haven't spent too much time on, but the crisis reinforces a secular trend towards more healthcare spending by governments, more universal coverage, both developed and emerging market economies. Research budgets, we think, will be boosted, as well as spending on infrastructure and equipment, and a different type of consumer, as we've been hearing about as well, and more ESG investing. So listen, we watch the path of the pandemic very carefully. It will have an impact in terms of growth forecast, but we don't think we return simply back to a pre-COVID world. We think the world has changed substantially from those as a result of this virus.
Cheers. Thanks very much for that. A question here that's come in from Manny. I'll put this one to you, Sam, if that's okay. So Manny's asking, what is the EU competition role post-Brexit, where M&A includes subsidiary operations in Europe, as most major large firms will also have registered operations in Europe?
Yes, thank you for that question, Manny. So the way it's going to work is, and so at the moment, if a deal reaches a particular size, then it's a one-stop shop clearance that's required in Brussels. What's going to happen going forward is that it will still be the case that if the deal reaches that size, that you will need to make a filing in Brussels, but you'll also need to consider making a filing in the UK in the event that there's an impact of that deal in the UK. If the financial thresholds for the Brussels merger regulation are not met, then you're going to need to look at the national rules in the member states in the EU in order to determine whether you're going to need to make national filings. So in sum, Brexit makes the whole situation just a bit more complicated and cumbersome. And if we add on to that the area I was talking about, foreign direct investment, I didn't have time to tell you, but the European Commission has put forward a framework which comes in October this year, 2020, around foreign direct investment. So when you're looking at deal making, definitely look at merger control, as Manny is suggesting, but also think about foreign direct investment, which has gone way beyond defense now and looks at public security, including security of supply of healthcare items.
Yeah, we've been hearing a lot about that obviously today, and sort of picking up on that theme, a question to you, Sunil. Look at this sort of the anti-China wave that's becoming obviously stronger in the UK, obviously with the visit yesterday and the removal of Huawei, sorry, get my words out, Huawei from the 5G network, and also talk obviously about the UK going even further with China expected to retaliate. Can't even get my words out today. Sorry, retaliate on sanctions in the UK. Given the major trade and investment in the UK, what effects do you think that this potential trade war could have on those sectors, Sunil?
Yeah, no, thank you, Chris. So I think I think my sense is all businesses, regardless of how well they've done or survived or sort of coped in the last few months, are, I suppose, re-looking at their business models right now, and this includes international businesses with global sort of global nodes in different locations. So when you look at what's currently happening with China and what may happen, I think most businesses are looking at sort of, as I mentioned earlier, sort of how do they secure their business, and what does that look like? That might mean security of supply chains, it might mean security of sort of third parties and so forth. So I think regardless of sort of what operations exist in China right now, I think businesses are taking a macro view of how will they thrive going forwards. To Henk's point, the world is changed, and the world is going to be very different going forwards. So my sense is out of that will arise some opportunities. There are some specific opportunities to India. I think as large multinationals look at sort of where they might site locations, where they might site additional manufacturing facilities. So there's an opportunity I think for other nations to take some of that investment from UK businesses going forwards. But I also think a lot of what we're seeing is a little bit of coming closer to home. So I think some operations being moved potentially out of China, out of India, out of other locations closer to home, back into the UK, let's say. So if you combine bringing trade back into the UK potentially because of security concerns, and then a thrust and a drive towards automation and driving more technology, you can actually achieve probably similar sort of cost efficiency gains going forwards. So it's a very complex set of things that boards and organizations have to look at. Depending on the sector, I think it really varies. If I looked at travel, obviously you sort of think about business travel to these locations like China, heavily reduced and unlikely to come back, I suspect, in the short term at the moment. But clearly, if you're in a different sector, there could be massive opportunities out of some of these things that are going on at the moment. So I would say probably a little bit more localism coming into to play in terms of making sure that people have got secure businesses, secure supply chains in terms of how they're operating. But I also think the use of technology will drive a lot of this change, and whether that's in China or India or here, the technology is here to stay, and that will really drive, I think, the opportunities for most businesses.
Cheers, thanks for that, Neil. I know we're up on time. We've got two more questions, so hopefully I can just run through these final two questions. Hopefully everyone's okay to stay on for a little bit of time. We've got a question here from Mandar, who's asking about the construction industry and post sort of COVID-19 scenarios. How would the Chancellor's £3 billion green investment package help the businesses in the UK? So I don't know if Sunil, you want to sort of take that one to start with, and maybe Sam and Henk, if you want to add anything.
Yeah, sure. Thanks, Chris. So I mean, I think we touched on it a little bit earlier, that I think we're going to see a different sort of way forwards for the economy, and I think one of the things that we're looking at the moment is definitely a more sustainable economy, and people are putting investments into green technologies, ESG. We're looking at obviously as well. So I think there are going to be, as these changes go through, I think sustainability, environmental impact, climate change are all going to be things that are going to be top of mind, I think, for business leaders. So if we move towards low density workplaces, reduction in office space, those things are all, will have net positive impacts, I think, for the overall environment and society. More cleaner transport models, we're seeing obviously more sort of electric vehicles, and so I think there'll be subsidies and incentives in all of these areas from the government to try to move towards a greener and more sustainable economy going forward. So I can't give any specific examples, but I mean, I think we're just going to see, I think, probably an increase in activity in this space going forward on the back of the government announcements.
Fantastic, thanks. Sam or Henk, anything you want to add?
This is Sam here. Maybe I...
Oh, please.
Please go, Henk.
No, just from our perspective, listen, I think it's going to be an important concept that we're going to see not only in the UK, but we've seen it around the world. The European Commission has just announced a €750 billion recovery fund. The key element, of course, of that is making the transition towards the green agenda and meeting its goals to reduce greenhouse gases by the time that we get to 2050. And from an investment perspective, which I focus on, I say we would expect to see more investment coming through in ESG projects. ESG funds have performed relatively well during the course of the market route. We've seen resilient inflows there, shows the merits of ESG as an efficient portfolio diversification tool. So I think it's important in terms of the progress that the policymakers are looking for a greener, more environmentally friendly world in which we all operate in. And I think investors will be very much attuned to that as well.
So, Chris, I was just going to add, in addition to green and ESG, I think what's really important is that part of the mandate of this UK government was regeneration of the regions in the UK, and construction plays a very important part in that. So I think you will see the government pushing in order to be able to assist regeneration of the regions, and the construction industry is really important to that. That is why state aid is such a contentious issue in the EU trade agreement, because the European Commission wants to, in a nutshell, control the amount of subsidies that the UK government provides, and the UK wants none of that. So watch this space.
Yeah, that was interesting. In my previous life in economic development, state aid was always the one question that we always had to work on. Just one final question, if we can try and keep the answers brief. In terms of this week, obviously, we're going to see the first virtual JETCO, the Joint Economic Trade Dialogue between the UK and Indian governments. So just quick question to the panel. What would you guys like to see on that agenda? Maybe Sunil, if we start with you.
Yes, thank you, Chris. Yes, so I know JETCO is coming up later this week. So I think I would like to see a reconfirmation, I think, of the sort of the relationship between the UK and India. We've obviously had all the Brexit sort of situation over the last couple of years, and now we've got COVID-19, and COVID-19 is absolutely impacting the UK economy, but it's equally, as we heard a couple of weeks ago, impacting the Indian economy. So I think I would like to see a reconfirmation of, I suppose, the direction, the joint direction for the two nations, and probably some more concrete plans. We hear a lot about the intent, but I'd like to probably hear a little bit more about the real sort of concrete substance between what the two governments can do together, working together to support more investment, more trade, more opportunities between the two countries. So I think probably a little bit more practical confirmation of what I think the two governments can put in place to support this important relationship that we have.
Cheers, thanks. Henk, anything that you want to add?
Well, listen, it's hard to make an economic argument for the benefits of Brexit. Of course, it's still our largest and most important trading partner. But the reality is, I suppose, if you're looking for one, it's free from European bureaucracy. Is it now possible for the UK to go out and do its own trade agreements with some faster growing parts of the world, some parts of the world that that will become increasingly important over the course of the next few decades? And we've heard an awful lot about, yes, there is sentiment sounds good. There's certainly hope that the nations can come together. But the reality is we haven't seen the concrete procedures put in place or agreements set out. And that's really what I think investors are looking for. So yes, there's hope. Yes, there's optimism around it. But the reality is these agreements take an awful lot of time to put in place, and they need to be starting to make tangible progress on those.
Thanks, Henk. Sam, anything from you? Any final comments?
I agree with the 2 points that have been made, and specifically from the point of view of the legal services industry, what we would like to see is mutual liberalisation in benefit, which would benefit, you know, the legal industry both in India and in the UK. Very
much something that UKIBC and I've been pushing for quite a long time. So fingers crossed. Let's hope that that is part of the agenda. Listen, it's a huge thank you to everybody for attending, and apologies we ran a little bit over, but I just wanted to get all those questions in. A huge thank you to Henk, Sunil and Samantha for their excellent contributions and taking us through what is a very, very complicated environment with some real clarity on that. So huge thank you. And a huge thank you from me, just to say, please stay safe, and we look forward to seeing you on the next UKIBC webinar. Finally, on the polls, 77% of you are suggesting it will be more than 12 months on the recovery, with 44% of that thinking it will take longer than 18 months. So again, a huge thank you, stay safe, and look forward to you joining our next UKIBC webinar. Thank you.